All right, let's get right into it. This is our briefing on the U.S. Market Peripheral Notes, covering Tuesday, March 10th, 2026.
This video presents a direct informational narration of the source document. No interpretation.
So here's what we're covering today. We've got 6 key sections. We're going to kick things off with a market overview on that headline shock. Then we'll get into the geopolitical strategy and the stalemate that's developing. From there, it's financial structure and liquidity, followed by a look at military deployment and energy. After that, we'll zoom in on some specific assets and stocks, and then we'll tie it all together with our conclusion and recommendations.
Risk disclosure and important notice. This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk, including the potential loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate materially and unpredictably. All strategies, market views, and analytical content are presented for reference only and do not constitute trading instructions, portfolio management guidance, or guarantees of future performance. Any investment decision should be made independently by the reader based on their own financial circumstances, objectives, and risk tolerance. Market conditions, liquidity, macroeconomic developments, policy changes, and unforeseen events may materially affect performance at any time. Past performance and historical analysis are not indicative of future results. Information contained herein may be time-sensitive and subject to change without notice.
All right, let's start with Section 1, the market overview. So on March 10th, things were actually looking up. We had a bit of a sentiment repair in the early session, but then, boom. At 2:13 in the afternoon, the U.S. equity market just took an abrupt dive. And what was the trigger? Well, it was a breaking report from CBS. They said U.S. intelligence had spotted Iran laying somewhere between 2,000 and 6,000 naval mines right in the Strait of Hormuz.
And, the market reaction was immediate and pretty severe. As soon as that headline dropped, intraday losses in crude oil started to shrink fast. The U.S. dollar index spiked, and you could just feel that risk-off sentiment ripple across all asset classes. But it didn't stop there. Things got worse because of a major breakdown in communication from the administration. Right when clarity was needed most, things got, dramatic. The Energy Secretary Chris Wright, he posted on social media that the U.S. military was already escorting tankers, which was wrong. He deleted it moments later, but the damage was done. A simple communication mistake like that really hurt the administration's credibility. So by the end of the day, the S&P 500 and the Dow closed down, just modestly, while the Nasdaq managed to finish flat, but only after giving back almost all of its gains for the day.
Diving a bit deeper, what this really shows is that market confidence is on a knife's edge right now. It's incredibly sensitive to any kind of disturbance at a global energy choke point like this. Now, the Trump administration, they did try to fix things with their signature move, what's called TACO, that's rhetoric-based market intervention. But because of the whole reversal with the Energy Secretary's comments, this attempt at managing expectations, it just completely backfired. Not only did it fail to bring back liquidity, it actually highlighted some serious coordination gaps in Washington. And really, the market's reaction just proves a fundamental point. When you're talking about a physical threat to supply, words alone aren't going to fix a liquidity problem.
So let's just walk through that timeline of events again because it was a whirlwind. It all kicks off at 2:13 p.m. That's when the CBS report about the naval mines hits. And like we said, crude losses narrowed, the dollar jumped, but what came next was this messy series of clarifications that just poured fuel on the fire. First, you had the Energy Secretary's incorrect post, and then the quick deletion. Then the White House had to come out and confirm, no, a military escort has not happened yet. And to top it all off, a spokesperson for the Iranian Revolutionary Guard came out and denied the whole mine-laying claim entirely. It was this exact sequence, this series of headlines and reversals, that whipped up all the volatility. Remember, before all this, oil was down, stocks were up. That one headline at 2:13 flipped the script instantly. It was that rapid-fire claim, misstatement, clarification, and then denial that led to all the wild swings right into the close.
Okay, let's move on to Section 2, where we're looking at the strategic narrative and geopolitical game theory here. What we're seeing is the Trump administration really trying to control the public narrative. They're framing this military operation as a short, quick action with, and I'm quoting here, manageable risk. And the goal of that, of course, is to try and stabilize how global assets are being priced. But if you look closer, there's a pretty clear disconnect between the rhetoric and the reality on the ground. On one hand, the administration keeps saying it's a short-term action. They want to avoid getting stuck in another Iraq-style quagmire. But on the other hand, they've set this incredibly high bar for success: Iran's unconditional surrender. So the strategy seems to be a combination of airstrikes and diplomatic intimidation, but with a firm refusal to put boots on the ground. And because of this, the market's thinking has changed.
It shifted from, oh, this conflict is almost over, to something more like, okay, the risk is lower, but it's definitely not gone. When you dig into the analysis, you find this kind of logical paradox. Trump's promise to keep it short has, in a way, prevented a total systemic collapse in U.S. stocks, unlike what we might have seen otherwise. But here's the catch. If you refuse to use ground troops but still demand unconditional surrender, you're almost guaranteed to create a long, drawn-out structural stalemate. So you have this mismatch between the short-term talk and the long-term actions. And what that means is the geopolitical risk premium, it's not going anywhere. It's going to stay baked into asset prices for a while, not just evaporate like the market was hoping for. And the White House's own public statements just reinforce this whole idea. They've said that the military action will only stop when Trump decides the objectives are met and Iran is unconditionally surrendered. He also made it clear that while it's a short-term operation, it's not ending this week. So when the market hears that, it does two things. It eases fears of a really long war, but it also forces everyone to accept that things could still escalate. And for that reason, traders are going to keep a certain amount of risk premium priced in.
All right, on to Section 3, financial structure and liquidity. And the big story here is that even if the macro story starts to sound better, the institutional models from places like Goldman Sachs and JP Morgan are telling us you can't ignore the fact that the market's underlying financial structure is getting worse. So, if you look at the S&P 500, the technical picture shows a real battle going on. The index seems to be capped right around that 6,850 squeeze zone. Now, the absolutely critical level to hold is 6,750. If that level breaks, we're very likely looking at a retest of 6,700. And when we look at what the big institutions are saying, well, Goldman Sachs is warning that CTA, systematic funds, have already hit their risk control triggers. That means they're being forced to deleverage, which is creating this algorithm-driven selling pressure. At the same time, JP Morgan's report is pointing out that we haven't seen a full washout-style deleveraging yet. Long positioning is basically neutral, and what that tells you is there just isn't enough energy on the buy side to absorb all the selling and spark a real short-covering rally. And this is the really crucial part of the Goldman Sachs warning. It doesn't matter if the market goes up or down next week, these CTAs are going to remain net sellers of equities, and we're not talking about a small amount. The projected scale of this selling is expected to be at a historical, record-breaking extreme. If you peek into the options market, you can see that large institutions are building up these put walls in the 6,600 to 6,700 range. They're doing this through rolling activity. And what's more, JP Morgan's caller positioning data shows us that 6,475 is really the ultimate institutional line in the sand. And until the S&P can get back above 6,900 and stay there, that defensive posture isn't going away. Okay, so the in-depth analysis here is pretty clear. In this kind of low liquidity environment, any negative news gets amplified by algorithmic trading. And since the big institutional players are choosing to roll their hedges instead of adding new long positions, the market could easily see another leg down. Now for the technicals on the U.S. equity indices. The S&P 500 is stuck in that battleground between 6,850 and 6,750. On March 10th, it did find support at 6,750 and turned higher. Looking at positioning, some shorts got squeezed out, but new longs are not chasing these prices. To reclaim the monthly moving average, we're going to need to see fresh, active buying come in. Otherwise, this rebound is just going to retest that 6,700 level. Let's turn to Wall Street's institutional views. Goldman Sachs is saying that while you can repair sentiment, you can't just magically create liquidity. The market is still facing pressure for a second bottom. Their models show the CTA deleveraging has been triggered and they're going to stay net sellers. JP Morgan's team agrees, adding that the market hasn't fully deleveraged yet and investors are holding neutral exposure. This means there's just not enough buying power to soak up all that CTA selling. A break below 67.35 would likely trigger even more aggressive selling. And what about institutional defensive positioning? Well, the options data shows the big players haven't let their guard down. They see this rebound as temporary. In fact, they've been increasing their exposure to low-strike puts. Support from puts in that 6,600 to 6,700 zone remains very firm. And within JP Morgan's structured positioning, that 6,475 level is a key area of put support. So, to wrap up the current technical positioning, sentiment has improved from outright panic to more of a manageable risk view, but it's definitely not a risk-on frenzy. The S&P 500 is trading between 6,850 and 6,750. That zone from 6,850 up to 6,860 is the last stop for short covering. Without new money coming in on the long side, the index is probably going to test 6,700 again very soon.
Okay, Section 4. Let's talk military deployment and energy supply. The key thing to understand here is that even though the White House is being verbally cautious, the actual U.S. force redeployments around the globe are painting a very different picture.
And the scale of this redeployment is, well, it's pretty unusual. We're seeing U.S. forces pull core capabilities out of Osan Air Base in South Korea. We're talking Patriot missiles and Army tactical missile systems. And where are they going? They're part of a historic buildup in the Middle East. We're now seeing 3 carrier strike groups there, which is a full quarter of the entire U.S. carrier fleet. This is the first time we've seen this kind of strategic concentration in one theater since the Iraq War back in 2003.
Now, to counter the potential shock of the Strait of Hormuz being closed, there's an energy price cap strategy in play. President Trump has issued a 30-day waiver that lets Russian oil be sold to India. At the same time, you have the G7 and the IEA managing expectations, and they've effectively set a price ceiling for oil at $120 a barrel. So, the in-depth analysis suggests that pulling all these high-readiness assets from East Asia means the situation in the Middle East is much more urgent than the short-term action story would have you believe. The strategy here is clearly designed to manage inflation expectations. We're expecting oil to trade in a wide range, probably between $75 and $100. To back this up, let's look at the latest military deployment details. South Korean Bahia is reporting that the U.S. is getting ready to redeploy those Patriot systems and ATACMS. C-5 and C-17 transport planes have been spotted frequently at Osan Air Base. The addition of a third carrier, the George H.W. Bush, is what will complete this unprecedented strategic assembly. And remember, the 3 core U.S. war objectives regarding Iran still haven't been met. Now, on the policy side for crude prices. Last week, the U.S. issued that 30-day waiver for Russian oil. The IEA also held a meeting on March 10th just to discuss supply, and that action alone helps manage market expectations. Look, if the Strait of Hormuz closes, it's very hard for oil prices to fall back. Oil is most likely going to bounce around between $75 and $100 a barrel. The threat of the G7 releasing strategic reserves should act as a cap on oil, keeping it at or below $120. But with the VIX hanging around 25, it's just too early for investors to start reducing their risk exposure.
Moving on to Section 5, where we'll focus on alternative assets and specific stocks. And what's really interesting is that against this backdrop of systemic risk, you're seeing capital flows diverge in some very clear ways. Take alternative assets, for instance. The whole idea of a safe haven is being reshaped. Bitcoin is back above $70,000 because its non-sovereign nature is attracting capital that's looking for a way to transfer assets. Circle, stock ticker CRCL, has actually doubled since its last earnings report. And then you have these political theme trades which are just in a speculative frenzy. A great example is AGH. This was a golf course operator, and its stock surged after it announced a merger with a drone startup that happens to be linked to Eric and Donald Trump Jr. Another one is UMAC, which has Donald Trump Jr. as an advisor. It's become a go-to stock for capital that's betting on increased military production. Over in the AI infrastructure space, Oracle is really serving as an anchor of certainty. Its third-quarter report was strong. Revenue hit $17.2 billion, and its OCI, that's cloud infrastructure, surged by 84%. But the really big number is remaining performance obligations, or RPO. This is future contracted revenue. It reached a massive $553 billion, and that's mostly driven by long-term AI service contracts. Oracle is also planning to expand its infrastructure through a $50 billion financing plan, which basically establishes a multi-year earnings floor for the entire AI infrastructure segment.
Then there's the managed care sector, which is in a bit of a trap. Centene, ticker CNC, kicked off a sell-off. What happened? Well, the company revealed that its Obamacare membership had plunged from 5.5 million down to 3.5 million. This was because those pandemic-era subsidies were withdrawn. This has created a negative feedback loop for the whole sector, hitting the entire group hard. Molina Healthcare, or MOH, is another one. It's been weak, and it just got removed from the S&P 500 index. This really reflects a full market repricing of the entire sector's earnings model. Okay, let's run through the specific data points for this section. First, on Bitcoin's market performance, it crossed back above $70,000 as capital moved into it as a non-sovereign asset during this geopolitical conflict. As a result, crypto-related stocks have rallied, and Circle, again, has doubled, completely trading out of sync with the broader market. Next, let's look at Oracle's fiscal 26 third-quarter numbers. Revenue was $17.2 billion, that's up 22% year-over-year. Cloud infrastructure revenue hit $4.9 billion, a surge of 84%. Total RPO reached $553 billion. Management also raised its fiscal 27 revenue guidance to $90 billion and is targeting $50 billion to fund its infrastructure expansion. Now, about the speculation in those Trump-related stocks. AGH jumped more than 12% after announcing its merger. The investment vehicle behind that deal is backed by Trump's sons. The other stock, UMAC, appointed one of Trump's sons to its advisory board back in 2024. And finally, a closer look at the health insurance segment. Centene did reaffirm its outlook, but the market was laser-focused on that drop in Obamacare membership, from about 5.5 million down to 3.5 million, which was definitely worse than expected. The recommendation here is to just wait until the panic selling has run its course. The other name, MOH, is also falling and, as mentioned, has been removed from the S&P 500.
And that brings us to our final section, number 6, conclusion and strategy recommendations. The bottom line is, with the VIX holding up near 25, investors really need to be maintaining extreme caution right now.
So the report wraps up with 4 specific strategy recommendations. First, on defensive strategy. Keep your focus on that JPM collar support level at 6,475 and avoid chasing any strength up near the 6,850 squeeze zone. Second, for hedging choices, it's important to recognize the hedging value of Bitcoin and other selected non-sovereign assets. Keep an eye on names like Circle that have their own independent momentum. Third, on sector selection. The recommendation is to stick with AI infrastructure leaders like Oracle, which offer that high RPO visibility, and to completely avoid the managed care segment for now. And fourth, and this is important, be wary of algorithmic liquidation. Given that CTA strategies are facing record net selling pressure, you should treat any rebound that doesn't have volume confirmation as an opportunity to reduce your positions.
Professional risk disclosure and important notice. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, trading advice, or any recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor, broker-dealer, financial planner, or fiduciary. No advisory or client relationship is created by the publication or use of this document. Investing and trading in financial markets involves substantial risk, including the possible loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate significantly and unpredictably due to market conditions, macroeconomic developments, policy changes, liquidity shifts, and unforeseen events. All market views, analyses, and discussions are provided strictly for informational and educational purposes. They do not constitute trading instructions, portfolio management guidance, or any form of guarantee regarding future performance or outcomes. Any investment or trading decision made based on this document is undertaken solely at the reader's own discretion and risk. Readers are responsible for conducting their own independent research, verification, and due diligence, and for evaluating whether any strategy or investment is appropriate in light of their personal financial situation, objectives, and risk tolerance. Past performance and historical analysis are not indicative of future results. Market conditions may change rapidly, and information contained herein may become outdated without notice.